Imagine waking up one morning and discovering that one of the most important commodities on Earth, something used in your phone, your solar panels, your electric car, is on the verge of a supply crisis that most people have absolutely no idea is happening. Not a rumor, not a Reddit theory. Cold, hard numbers. Before we dive in, this is not financial advice. Trading silver or any assets carries substantial risk of loss. Do your own research and consult a professional if needed. Right now, as you're watching this video, silver's physical inventory on the COMEX exchange has dropped 31% in just 5 months. Delivery volumes are breaking records that haven't been touched in decades, and prices just swung from an all-time high of $121 an ounce back down to $81. So today, I'm going to walk you through exactly what is happening in the silver and gold markets right now, why it matters to your financial future, and more importantly, what you should actually do about it. Stay until the end, because I'm going to share something about COMEX mechanics that most retail investors never learn, and it could change how you look at precious metals forever. Let's get into it. Before we dive in, let me be upfront with you. This isn't a video telling you to buy silver, it's going to $1,000. I've seen those videos. You've seen those videos, and frankly, most of them are noise. What this video is a breakdown of real, verifiable data from CME Group reports, the Silver Institute, JPMorgan, and market delivery records, so that you can make informed decisions. Because here's the thing. The precious metals market in early 2026 is genuinely unlike anything we've seen in recent history, and you deserve to understand what's actually driving it. So let me break this down in 3 sections. 1. Where prices actually are right now and how we got here. 2. The supply and delivery story that Wall Street isn't screaming about. 3. The bigger economic picture and what historically has worked for investors in moments like this. Let's start with the price. If you were watching silver in January 2026, you saw something extraordinary. The price of silver hit $121.64 per ounce, a record, an absolute all-time high. And then, just weeks later, it's sitting at $81.31 as of March 3rd, 2026, down nearly 9% in a single day. Down roughly 33% from that January peak. Now, most people see that and think, oh, it crashed, I missed it, but that's exactly the wrong way to look at it. Zoom out for just 1 second. A year ago, silver was trading at roughly $32 an ounce. Today, it's at $81. That's a 154% gain year over year. To put that in context, gold, which everyone is talking about, is up about 78% in the same period. Silver doubled gold's performance, quietly, without half the headlines. So why did it spike to $121 and then pull back so hard? 2 words: geopolitical shock. The escalation in the US-Iran conflict in early 2026 triggered a massive safe haven rush. Silver, which acts as both a safe haven asset like gold and an industrial metal, got caught in a tug-of-war. Investors rushed in. Then recession fears from oil prices above $120 a barrel scared industrial demand projections. And the US dollar strengthened, and silver, which is more sensitive to all of that than gold, corrected hard. Gold tells a different story. As of March 3rd, 2026, gold is sitting at $5,191 per ounce, down about 2.9% on the day, but still up 78% year over year. Its record high this year was $5,589 in January. The gold-silver ratio right now is hovering around 57. For context, historically, that number sits closer to 70 or 80. A compressed ratio like this tells us silver has been performing exceptionally relative to gold. So, both metals are elevated, both had dramatic January peaks, and both pulled back. But here's where it gets really interesting, and this is the part most financial media completely ignores. Let me introduce you to COMEX. COMEX, the commodity exchange, is the primary U.S. futures exchange for trading precious metals. It's where the paper price of gold and silver gets set every day. Now, here's what most people don't know. When you trade futures on COMEX, you're not necessarily buying physical metal. You're buying a contract, a promise to buy or sell metal at a specific price on a specific date. Over 99% of these contracts never result in physical delivery. They get rolled over or cash settled. But that 1% that does demand physical delivery, that's where things get very, very interesting right now. There are two kinds of silver sitting in COMEX-approved vaults. Eligible inventory is metal stored in approved facilities that meets quality standards, but it's privately owned and not available for futures delivery unless the owner decides to register it. Registered inventory is the metal that has been formally submitted and is available for delivery against futures contracts. This is the critical number. This is the deliverable pool. Registered silver inventory on COMEX right now sits at approximately 86 to 88 million ounces. That sounds like a lot, until you look at the context. Back in April 2020, registered silver sat at 240 million ounces. We're now at roughly a third of that level, a 64% decline in under 6 years. And total COMEX silver inventory, eligible plus registered, has fallen 31% just since October 2025, from 532 million ounces down to 366 million ounces in 5 months. Here's where it gets truly remarkable. In January 2026, a minor delivery month, meaning its historically low volume, COMEX delivered approximately 49 million ounces of silver. That's 4 to 10 times the January 2024 level, an all-time record for a minor month. February 2026, another minor month, another record. Roughly 25 million ounces delivered, with a delivery rate of approximately 98% of open interest. That is unheard of. And March is a major delivery month. It started with over 10,500 open contracts, representing more than 52 million ounces of potential demand, against only 86 million ounces in registered inventory. In just the first 2 days of March, over 25 million ounces were delivered. That's 141% more front-loading than the same period in February. Total deliveries in just the last 60 days? Over 74 million ounces. That's 86% of current registered inventory consumed in 2 months. Now, does this mean COMEX is about to default? No. CME Group has mechanisms, including cash settlement and the ability to pull eligible into registered, that prevent outright default. But what it does signal is genuine, persistent physical demand that is straining the system in ways we haven't seen before. Gold deliveries, for context, are far more stable. Total COMEX gold inventory is around 33 million ounces, with 8 to 9 million ounces registered. Deliveries are running near historical norms, institutional, methodical, driven primarily by central bank and hedge fund activity rather than the kind of stress we're seeing in silver. Gold is elevated and tightening. Silver is in a different category entirely. Here's the uncomfortable truth about silver that the mainstream financial media glosses over. The silver market has been in a supply deficit for 6 consecutive years. In 2026, that deficit is projected at 67 million ounces. In 2025, it was 95 million ounces. Over 5 years, cumulative deficits have exceeded 800 million ounces, roughly equivalent to an entire year of global mine production. That metal has to come from somewhere, and it's been coming from above-ground stockpiles, which are now significantly depleted. Global silver mine production is approximately 850 million ounces per year, essentially flat. Ore grades are declining. There are no major new mine projects coming online, despite prices being at multi-decade highs. Even with recycling added in, total supply is only projected to rise about 1.5% in 2026. Industrial demand accounts for roughly 50% of all silver consumption, and it's not slowing down. Solar panels, AI data centers, electric vehicles, consumer electronics. These aren't trends, they're structural shifts in how the global economy operates. The Silver Institute projects industrial demand continuing to grow at roughly 15% year over year. Even with some thrifting, where manufacturers trying to substitute cheaper materials in applications like solar paste, the demand trajectory remains firmly upward. Add in elevated investor demand, ETF buying, physical bars and coins, and central bank reserve diversification, and you have a market where the math simply doesn't balance in the short term. Let's talk price forecasts, because I want to give you the full spectrum, not just the bullish case. JPMorgan, one of the most influential voices in commodity markets, has a 2026 average forecast for silver of around $81 per ounce, with quarterly targets ranging from $75 to $85. They note silver is more than double 2025's $40 average and cite supply tightness as the key driver. Bank of America has a high-end target of $309 per ounce, an aggressive call based on an industrial demand boom scenario. Trading Economics macro models point to a 12-month target of $115.60. The consensus range is wide, $49 to $309, which tells you something important. Nobody actually knows. Anyone claiming certainty is selling you something. For gold, the forecasts are similarly varied but generally bullish. Goldman Sachs targets $5,400 by year-end. Bank of America sees $6,000 within 12 months. UBS has $6,200 as a potential peak. Here's my honest take on these forecasts. The range exists because precious metals are sensitive to things that are genuinely unpredictable. Geopolitics, Fed policy, currency movements, recession probability. What the forecasts agree on is the direction. Structurally, the fundamentals support higher prices over time. The timing is where it gets murky. Let's zoom out even further, because the silver and gold story doesn't exist in a vacuum. U.S. national debt crossed $38 trillion entering 2026. Interest payments on that debt now exceed $1 trillion annually, more than what the government spends on veterans, infrastructure, or education. That's not a political statement. The Federal Reserve began what they're calling reserve management purchases in December 2025, essentially a new form of asset purchases at approximately $40 billion per month. Over 12 months, that's roughly $220 billion in new money entering the financial system. M2 money supply grew about 3.8% in 2025 alone, and is up roughly 77% over the past decade. When more dollars are created, each existing dollar buys less. That's not conspiracy, that's economics 101. And historically, assets with limited supply, gold, silver, real estate, productive businesses, tend to hold their purchasing power better than cash during periods of sustained money creation. Central banks around the world understand this. In 2025, they purchased 863 tons of gold. That's 4 to 5 times pre-2022 buying levels. They're not doing that because they think gold is a relic. They're doing it because they understand what prolonged deficit spending and monetary expansion eventually do to currency values. And then there's the geopolitical dimension. Defense sector backlogs are at records. Raytheon at $251 billion. Lockheed Martin at $194 billion, Northrop Grumman at $95 billion. The iShares U.S. Aerospace and Defense ETF was up approximately 90% in 2025. These aren't abstract numbers. They reflect a world that is spending heavily on security infrastructure. Now, I want to be balanced here. These trends can reverse. Oil historically spikes during conflicts, and then crashes as situations resolve or demand adjusts. Defense stocks are cyclical. Gold has had multi-year flat periods. There are no sure things in investing. Okay, you've made it this far. Let's talk about what any of this actually means for you. First, don't panic buy or panic sell. The worst investment decisions are made from emotion, whether that's fear of missing out or fear of losing. Silver dropping 9% in a day feels dramatic. But in a year where it's up 154%, a 9% daily swing is noise, not signal. Second, understand what you own before you buy it. Physical silver and gold, bars, coins, behave differently from silver ETFs, which behave differently from silver mining stocks. Each has different risk profiles, liquidity, and tax implications. Know the difference before you allocate. Third, think in terms of allocation, not all-in bets. Many financial advisors suggest a 5 to 15% allocation to precious metals as a portfolio hedge. Not your entire savings, a hedge, something that holds value when other assets don't. Fourth, watch the COMEX delivery data if you're serious. CME Group publishes daily reports on registered inventory, deliveries issued and stopped, and open interest. If you're following silver closely, these numbers, available publicly, will tell you more about physical demand than any analyst's price target. And fifth, consult a qualified financial professional. Everything in this video is for educational purposes. Your financial situation, tax bracket, risk tolerance, and time horizon are unique to you. A professional can help you think through allocation decisions that make sense for your life. Look, the silver and gold markets in 2026 are telling us something. Whether it's the COMEX delivery stress, the 6 consecutive years of supply deficits, the central bank buying, or the geopolitical backdrop, the fundamentals are worth paying attention to. You don't have to believe any single price forecast, but dismissing precious metals entirely while the structural data looks like this would be the same kind of mistake people made with energy stocks in 2021 or tech in 2019. Ignoring something because it seems boring until the moment it isn't. If this video gave you something useful, a new framework, a new data point, a new question to ask, then hit that like button. It genuinely helps this channel reach more people who are trying to make sense of what's happening in the economy. Subscribe if you want more of this kind of analysis. I cover precious metals, macro trends, and market mechanics, without the hype, without the fear-mongering, just the numbers and what they mean. And drop a comment. What's your current take on silver? Is this a buying opportunity or a falling knife? I read every comment, and I'll be in the replies. Next video, we're going to break down exactly how the COMEX delivery process works step by step, and why understanding it gives you an edge that most retail investors simply don't have. I'll see you there. Stay curious, stay informed.